Think about the stock market. You probably picture a room full of screaming traders, a wall of blinking computer screens, and complicated math formulas that look like a foreign language. But the most successful investor in history works completely differently. Warren Buffett operates out of a quiet, unassuming office in Omaha, Nebraska. No shouting, no frantically blinking screens. His method is laid out in a book called The Warren Buffett Way, and it has earned high praise from other legendary investors like Peter Lynch because it proves you don't need a Wall Street background to succeed. We are going to strip away the financial jargon and look at 5 practical takeaways from Buffett's approach that anyone can use to start building wealth. A lot of people treat the stock market like a casino. They buy a stock simply because the line on a chart is going up, hoping they can quickly sell it to someone else for a profit. Buffett's first rule is to remember that a stock is a tiny slice of an actual business. When you buy shares, you become a part owner of a real-world company with real products, employees, and customers. Take See's Candies, a company Buffett bought. He doesn't need to check a daily ticker symbol to know how See's is doing. He looks at whether the candy shops are pumping out cash year after year. The daily noise of the stock market does not matter if the real-world business is thriving. The goal is to only buy a piece of a business that you would be proud to own forever, even if the stock market closed its doors tomorrow. You might think you need to be an expert on the entire global economy to make money. The truth is, you only need to understand a few specific industries really well. Buffett calls this your circle of competence. Inside the circle are businesses you easily understand, like candy or car insurance. Outside are the complex businesses you don't. During the late 1990s, Buffett famously refused to buy popular internet stocks because they sat completely outside his circle. He didn't rush it. He read the annual reports for IBM for 50 years, observing how they kept their clients, before his circle finally expanded to include them. Knowing what you don't know is actually a massive advantage. You protect your money when you stick strictly to the things that make logical sense to you. In 1976, the auto insurance company Geico was in deep trouble. The media was predicting doom, and terrified investors were dumping their shares, driving the price down to just $2. This chart shows what Buffett looks for in a moment of panic. The tall line represents what the company is actually worth, while the lower line is the panicked market price. Buffett only buys when there is a massive gap between the two, a safety buffer he calls a margin of safety. Buffett ignored the headlines and did the math. He saw that GEICO's true worth was much higher than $2, so he used that huge gap to protect himself while he bought millions of shares at a discount. Price is simply what you pay, but value is what you actually get. Always look for that protective cap to help secure your investment. The financial industry is built to encourage constant activity. Brokers and apps make money when you buy, sell, and move your cash around as often as possible. To combat this pressure, Buffett likes to use an analogy featuring baseball legend Ted Williams. Williams divided his strike zone into a grid of 77 distinct squares. He knew that if he swung at pitches on the outer edges, his batting average would drop, so he would stand at the plate and ignore pitch after pitch, willing to take strikes until the ball crossed into his one specific red-hot square. The stock market works the same way, but with one huge advantage: there are no called strikes in investing. You can watch hundreds of opportunities flying past you without ever facing a penalty. You can sit patiently, holding on to your cash, completely inactive, until a business you understand at a price that makes sense lands right in your sweet spot. You can understand the math and read all the annual reports in the world, but without emotional control, none of it matters. Humans are naturally wired to follow the herd. We feel completely safe doing what everyone else is doing. We tend to get greedy when we see our neighbors getting rich, and we sell in absolute terror when the market drops. Look at the global financial collapse in 2008. Fear took over, and even professional managers were forced to sell off their investments at bargain prices just to get out. While the world panicked, Buffett stayed rational. Amidst all that fear, he confidently spent $34 billion to buy the Burlington Northern Santa Fe Railway. When the world starts acting on emotion, the most powerful tool you have is your own rationality. It allows you to see opportunity where everyone else only sees disaster. So here is the playbook. Buy real businesses, not ticker symbols. Stay inside your circle of confidence. Demand a margin of safety. wait for the perfect pitch, and master your emotions. Buffett's success doesn't come from a secret formula, but from the willingness to be patient while everyone else is in a hurry. It's an approach built on independent thinking, trusting your own research instead of following the crowd. Think about your own career or daily choices. Where are you currently swinging at bad pitches out of pressure, and how could you benefit by holding off until you see your perfect pitch? Take a breath, trust your own logic, and remember that sometimes the most profitable move you can make is simply doing nothing at all until the time is right. If you like this video, please like, share, and subscribe to the channel for more.